This video will describe our trading zones, which is one of our new scripts and one of the most powerful tools in our software for multiple reasons. To add this script and tool to your chart, right click on the chart, chart settings, go to add script, scroll down to trading zones, and the default is 85%. What this means is we go back over the last 20 days and see how much each currency moves per day. Let's say, for example, this currency over the last 20 days averages 100 pips up and down per day. This would start showing likely reversal areas, 85 pips up and 85 pips down from the beginning of the day. And as price goes down, we then show later in the day likely reversal areas based on the lowest low of the day. Let's say in that example it was 100 pips, 85% of that is 85 pips, and we'll start showing resistance levels from the lowest low. Other currencies start the day and go up, and therefore we show the likely buy areas, and as the price goes up we yank and show new likely lows later in the day. Many days currencies open and trend one way all day, but on other days they might fall 50 or 80 pips and then explode up, and you will oftentimes see zones that were not there earlier in the day show up later, and they're very accurate in our opinion. These support resistance levels are made up of the previous day's high and low, the previous week's high and low, previous month's high and low, weekly pivots, monthly pivots, and even daily pivots, and each level has a different weight, and that's why some lines are thicker than other ones. And on top of that, we also display likely Fibonacci retracement levels and likely Fibonacci profit target levels that are very likely to stall price. And those, unlike the other zones, can show up in the middle of the day's range as well. As you can see, the market last night hit that level and there was some buying there. It stopped it from falling, and today it started going back down. Notice it went right to the next Fibonacci level, which oftentimes, as you can see in this example, showed a lot of buying, which caused it to go up a little bit, 30 or 40 pips. And once it broke that level, it's likely to go to the next level, which not only was a Fibonacci level, but was also one of our other support areas as well, as you can see. Let's show some other examples of this. This is a euro yen. Here's a euro dollar. Notice the first buy level, there was some support. Went to the next one, there was some support. Oftentimes you'll see at the second and farthest down level some buying that causes it to go up, and in this case the euro dollar was weak and it went down to the next level, which was pretty much the low. One of the keys to trading is having small losses and big wins, and also avoiding unnecessary trades. For example, you might not have wanted to sell right here with a likely buy area right underneath you. The likelihood of a big profit was very tiny. But once this level got broke, it was likely to go to here, which is about 50 pips away for a decent profit. You know, if you risk 10 pips, you should take trades that are likely to give you 20, 30, or 50, or at least have the potential. And this allows you to do that. If the market doesn't hold this level and it breaks down, you go short right here, it's likely to go to the next level. There were no Fibonacci levels that showed up on this particular example. Here's the dollar CAD. One of our Fibonacci levels was here, and you can see the market stalled. When it went above that level, it was a pretty decent trade because the next area and profit target is up here. And because this was so strong, it went right through that sell area right up to the next Fibonacci level, which almost to the exact pip nailed the high in this particular currency. So these are extremely powerful tools, and as you can see in this example, as the price goes up, we start showing zones for later in the day or the Asian session that could act as support and major buying in the future. Here's the pound dollar. Notice how there was buying at this trading zone here, and once it broke that level, it was likely to go to the next area, which it did almost to the pip. Very high probability tools. Here's the pound yen. Notice how that Fibonacci level acted as a buy area. The market stalled there for almost two and a half hours. And when it broke underneath that level, it was a great trade because the next area where there's likely to be some buying is all the way down here and here, which the market went to, a full 75 pips away. So if you took this trade with a 15 pip stop, you had a pretty decent chance of making 50 to 75 pips. That's one of the key secrets to trading. Focusing on trades that are likely to give you, or have the chance to give you, a lot more pips than you're risking. And our tool lets you do that without having to spend 30 to 40 minutes a day doing your Fibonacci analysis on the daily charts, weekly charts, and over the last 3 to 5 days on 4-hour charts. We do these every day for you, saving you 30 minutes to an hour a day, and you can just sit down and you know all these key levels right on your chart. Here's the Australian dollar. Notice how this level had some buying. It went to the next fib level, and once it broke that level, it was likely to go down to the next level, which it did, a full 30 or 35 pips away. Decent trade right here, low risk, because if you're wrong, you're going to lose 10 pips, and if you're right, you're probably going to make 25 or 30. And notice also that the upper bands came down. If the market finds support here and explodes up, it's likely to stall probably at this level or this, and this is likely to be the highest high of the day. If it does explode up, it's not very likely to go above this zone up here between 9100 and 9125. And not every currency moves enough to hit our likely buy and sell levels, and oftentimes there are no valid Fibonacci levels that are going to play an impact in your trading. And in this case, there are no fib levels in the middle of the range, and the market was pretty dead. It wasn't strong enough to get to the sell zone or weak enough to get to the buy zone. This concludes our training on how to use our new trading zones. Advanced users might want to adjust the percentage range under various circumstances. For instance, if a currency moves significantly more one day than it normally does, and you think it's going to stall somewhere up the next day, you might change the 85% to 60 or 65% to give you possible areas for a counter trend short the next day. It's not likely to trend that much the next day after a huge move the previous day. Conversely, if a currency does not move much one day or 2 days in a row, it's likely to trend more the next day, and you might widen the percentage to 100 or even 110% or more, so that you're not tempted to get out of the trend trades too soon the next day, and you're also not tempted to do counter trend trades at these many times likely reversal areas.